Something is hiding in plain sight right now, and the people who run the trading desks would very much prefer you keep staring at the wrong screen. Everyone is watching gold. Gold at record after record, gold on every headline, gold in every advisor's mouth. And while the whole world has its eyes fixed on the yellow metal, the real story, the setup nobody saw coming, has been quietly assembling itself in silver, off to the side, in the shadow of the bigger, louder metal. If you are holding silver right now, or you have been thinking about it and you keep getting talked out of it, I want you to stay with me for the next few minutes, because what I am about to show you is not a prediction and it is not a promise. It is a pattern, a very old, very reliable pattern in the way these two metals move together, and the way one of them tends to make its biggest move only after everyone has stopped paying attention. By the time this is over, you will understand why the quiet in silver may be the loudest signal of all. Here is the down payment, the one concrete thing I want you chewing on before we go any deeper. Gold leads, silver follows. That is not my opinion. That is the observed behavior of these two metals across generation after generation. When a real monetary move gets going, gold tends to move first. Gold makes the records. Gold gets the attention. And silver, the smaller, thinner, more volatile market, tends to lag, to drag, to sit there looking like the metal everyone forgot, right up until the moment it doesn't. The lag is not a sign that silver is broken. Historically, the lag has been the setup. Think about what that means for a second, because it is almost backwards from how people feel it. When gold is roaring and silver is dragging, the average saver looks at silver and feels disappointment. He feels like he bet on the wrong horse. The financial media reinforces it. Gold, gold, gold. And silver becomes the afterthought, the underperformer, the one you were foolish to own. And that feeling, that quiet disappointment, is precisely the emotional bottom that has preceded silver's most violent catch-up moves in the past. The setup does not announce itself. It disguises itself as a mistake. Let me take you back to the last time this pattern ran its full course, because the story is worth telling accurately. Through the 1970s, gold went on one of the great monetary runs in modern history. When the dollar was cut loose from gold at the start of that decade, gold was priced in the mid-30s. By the end of the decade, it was over 800, roughly a 20-fold move across 10 years, and it did not go in a straight line. In the middle of that bull market, gold fell by nearly half, from around 200 back down toward 100, and a lot of people gave up right there, convinced the run was over. It was not over. From that mid-decade low, gold multiplied about 8 times into its peak. The ones who held through the scary middle were the ones who were there for the parabola. Now, here is the part that matters for silver, and for you. Silver did not lead that move. Silver followed it. For most of that decade, silver was the lagging metal, the one that made you wait. And then, late, right at the end, silver did not just catch up to gold. It went vertical. It ran to a ceiling near $50, a number so far above where it had traded for most of the decade that it seemed impossible. The metal everyone had been patient with and frustrated by delivered its entire move in a compressed, violent window at the very end. The lag was the whole story. The people who understood the lag were positioned before the fireworks. And that ceiling, near 50, is one of the most remarkable facts in all of markets, because silver has touched it twice and about 31 years apart. Once at the start of the 1980s, and then again more than 3 decades later, in the spring of 2011. 2 peaks, roughly the same nominal level, separated by a generation, which means the base beneath that ceiling, the long floor silver has been building, is something like 45 years wide. Markets do not build 45-year bases for nothing. A base that long is a coiled spring. It is energy stored, not energy spent. Let me make that even more concrete, because it is the kind of fact the financial channels will never sit you down and explain. That 1980 high, near $50, was in the money of its day. Adjusted for everything that has happened to the dollar since, all the inflation, all the erosion, and the real inflation-adjusted peak in silver is not 50. It is well up into the low 3 figures in today's money. And silver has never reclaimed that real high, not once. Gold has made new records, new all-time highs over and over. Silver, in real terms, is still trading below where it was more than 40 years ago. Let that sit with you. One of these metals is at records. The other is still underwater against its own history. That gap is not a warning. That gap is the setup. Now, I want to be honest with you about why silver drags in the first place, because understanding the mechanism is what protects you from being shaken out of it. Silver is a smaller market than gold, thinner, more volatile. It gets pushed around harder in both directions. When there is fear in the system, silver falls faster than gold. When a panic hits, people sell what they can, and in the deepest moments of fear, even good assets get sold, simply because they are liquid, because someone needs the cash. That is true of gold, and it is true of silver only more so, because the thinner market amplifies every push in both directions. The very volatility that makes silver frightening on the way down is the same volatility that makes it explosive on the way up. And here is where the enemy comes into focus, because someone profits from that volatility, and it is not you. The big banks and the trading desks that dominate the paper silver market make their money on your churn, on your fear, on you buying high in excitement and selling low in panic. A frightened retiree dumping metal into a shakeout is their paying customer, and they have tools you do not have. Back in 2011, when silver was up near that $50 ceiling, the exchange raised margin requirements again and again in a matter of days, and silver fell around 30%. Nothing fundamental about silver changed in those few days. Not the supply, not the demand, not the deficits. The paper rules changed, and a lot of good people got flushed out of a good position because the game was tilted, and nobody told them the tilt was coming. That is exactly the right moment for me to stop and say something directly to you, because if any of this is landing, you should know there is a concrete protective step available to you. Right now, the largest and most sophisticated buyers on the planet, the central banks, are accumulating gold at a pace we have not seen in generations. More than 1,000 tons a year, 3 years running, roughly double what they were buying the decade before. Gold recently overtook the euro to become the second largest reserve asset central banks hold, behind only the US dollar. These are the people with the best information in the world, and they are quietly moving into hard metal while the headlines talk about everything else. Here is the part almost nobody tells ordinary savers. There is a perfectly legal way for you to do the very same thing inside the retirement account you already have. You can move a portion of an existing 401k or IRA into physical gold and silver, held in a real vault in your name, without triggering taxes and without penalties, through what is called a self-directed precious metals IRA. This is not some insiders-only club. If you have $100,000 or more in any retirement account, this is available to you. I put together a free retirement protection guide that walks through exactly how it works, step by step. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com and we will get it into your hands. Then come right back because the setup gets more interesting from here. So let us talk about now, because the pattern is not just history, it is happening again in real time, right in front of you. Silver went through a sharp, deep correction, a hard shakeout that fell back toward the very zone it had broken out from, what traders call a return to the launch pad. And through most of that drop, gold sat there, gold held, gold barely flinched while silver did all the bleeding. That is the divergence. That is gold leading and silver lagging, the exact behavior we have been talking about unfolding again. And the gap between them, the gold to silver ratio, widened out, which is just a technical way of saying silver got cheaper and cheaper relative to gold, right while everyone's attention was locked on gold's records. And here is the mid-story turn, the part that actually changes things and that almost nobody is framing correctly for you. That ratio, after widening out, has recently started to compress again. Silver has begun to firm, to steady, to try to outpace gold instead of lag it. In plain English, the early sign of a catch-up move is that silver stops falling faster than gold and starts rising faster than gold. That is what a lag ending looks like from the inside. It does not ring a bell. It does not lead the news. It shows up first as a quiet narrowing of the gap, while the crowd is still busy being disappointed in silver. If you only ever watch the gold price, you will miss the exact moment the setup starts to pay. I want to widen the lens for a moment, because this lagging behavior is not a quirk of silver. It is a rhythm you can see all through monetary history, and once you see it, you cannot unsee it. Think about how these moves actually begin. In 1971, when the dollar was cut loose from gold, they called it temporary. It was never reversed. A few years before that, a group of nations spent down their reserves trying to hold the price of gold at a fixed level, and then one day they simply abandoned it overnight. The big turns in this world do not come with a warning label. They come quietly, and the official story is always that nothing has really changed, right up until everything has. Silver's lag is that same rhythm, playing out on a smaller stage. The quiet is not the absence of the move. The quiet is the beginning of it. And notice who tends to buy at the very bottom, because it tells you everything about where value actually sits. The most metal changes hands not at the top, in the excitement, but at the bottom, out of need. The frightened saver who bought too big and cannot take another red day is the one who lets his metal go near the lows. Not because he has changed his mind about it, but because he simply has to. He is not selling on an opinion. He is selling on a margin call, a bill, a moment of panic. Meanwhile, the patient buyer on the other side of that trade is quietly accumulating. That is the shape of a bottom, not a headline, a quiet transfer from the people who need cash to the people who understand value. Now, underneath all of this, beneath the paper games and the ratio and the shakeouts, there is a hard physical reality that makes silver different from gold in a way that matters enormously. Gold is hoarded. Silver is burned. Almost every ounce of gold ever mined still exists, sitting in vaults and jewelry and coins. But silver gets consumed. It goes into solar panels, into electronics, into the guts of the modern economy, in tiny amounts, dispersed across billions of devices, most of it never economically recoverable. It is gone. And the world has now run a structural silver deficit for years running, demand outstripping supply, drawing down the above-ground stockpile year after year to cover the gap. That deficit does not care what the screen printed this morning. It does not care about a margin hike. It is a slow, grinding, physical shortage building underneath a market that most people only ever look at as a price on a screen. Let me stitch the pillars together, because this is the whole case in one breath. You have a metal that has built a base more than 40 years wide. You have a real, inflation-adjusted high that has never been reclaimed, unlike gold. You have the oldest reliable pattern in the metals, gold leading and silver following late and hard. You have central banks buying hard metal at a record pace, telling you where the smart money is going. You have a genuine multi-year physical deficit draining the supply. And you have right now a fresh shakeout that flushed the weak hands and a ratio that has started to turn. Every one of those pillars points the same direction, not to a guaranteed number and not to a date, but to a setup. A setup that has been hiding deliberately in the shadow of gold's headlines. I want to be very honest with you about the risks, because anyone who is not honest about the risks is trying to sell you something, and I would rather keep your trust. Silver is volatile. It can and does fall hard, fast, for reasons that have nothing to do with its long-term value, the way it did when the paper rules changed. The Federal Reserve, under its current chair, has surprised the market with a more hawkish posture than many expected, and a hawkish Fed can pressure metals in the short run. There will be more shakeouts. There will be days that test your stomach. This is a case built on history and structure and the behavior of the biggest buyers on Earth. It is not a guarantee, and nothing I say to you is personal financial advice. What I can tell you is that the pattern is real, and the people who understand it tend to be positioned before the crowd, not after. So what should you actually do about the metal you own, or the metal you are considering? A few plain principles, not a prescription. Own the metal itself, the physical thing in a vault or in your hand, not a paper promise that can be diluted 100 claims to an ounce and settled in cash when it matters most. Size your position so that no shakeout, no 30% flush can ever force you to sell. The people who get destroyed in silver are not the ones who are wrong about the metal. They are the ones who bought too big, got scared at the bottom, and sold into the very shakeout that was designed to take their metal. Do not be that person, and do not sell into the fear. The whole point of understanding the lag is that you do not panic during it. Which brings me to the thing I most want you to sit with before we close. You are early. I do not say that to flatter you, I say it because it is true, and it is the entire reason any of this matters. The smart money, the central banks, they already see it. They are already positioned. But the mainstream has not caught on. The pension funds, the financial media, the advisor down the street, they are all still watching gold, still treating silver as the afterthought, still disappointed in the lag. And that is exactly where you want to be. Because by the time Silver's move is obvious, by the time it leads every segment and every advisor recommends it, and your neighbor is asking you how to buy it, the easy part of the move will already be behind us. Nobody sends you an invitation to the beginning. There is no announcement. The setup is quiet by its nature, and the quiet is the opportunity. So let me answer the question the title asked, plainly and honestly. The silver setup nobody saw coming is not some secret catalyst or a rumor whispered on a trading floor. It is the oldest, most reliable thing in the metals, hiding in plain sight. Gold leads, silver lags. And the lag, the very thing that makes silver look like a mistake at record highs in gold, is the setup. It is visible to anyone willing to look past the headline metal. That is why nobody saw it coming, because it was never hidden. It was just ignored. And if you are watching this all the way to the end, you are not ignoring it anymore. If you want to act on being early, here is how. I hold a free one-on-one educational web conference, specifically for viewers with $100,000 or more in a retirement account. People who watched a video like this all the way through and want to understand their real options. It is genuinely educational. There is no obligation and no pressure. And the reason to do it now is not fake urgency. It is the opposite. The best time to make a calm, careful decision like this is precisely when nothing feels like an emergency, while the setup is still quiet and the crowd has not arrived. If you are watching on your TV, scan the QR code on your screen to book your spot. If you are on your phone or your computer, go to jeffweedguide.com and mention that you watched this all the way to the end. Come and let us walk through your situation together, calmly, before it becomes obvious to everyone else. Because by the time it is obvious, the easy part will already be behind us. And nobody is going to call you and tell you it is time.